Hello and welcome to Wall Street Vision. On this show, we explore the thinking of the best investors and we examine lessons from the stock market. I'm your host, Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. Hello, Vision Nation! Summer's in the air in Toronto, and I hope it's a sunny and warm start to the week where you are as well. Alright, so far on this podcast, we've mostly covered investments that have worked out really well for people. In this episode, I want to do something a little different. I want to go over one investing mistake that Warren Buffett made when he was already a very seasoned professional. The story took place when he was in his 60s. I think it's useful to learn from people's successes, but it's also important to learn from their mistakes as well. As you're going to see in the story, Warren Buffett messed up and it cost his company something like $10 billion. I want to mention that I've personally made a ton of mistakes in my life, and I'm sure I'm going to make a ton more mistakes, and this is not a knock against Buffett. If you've listened to a few episodes of the show, you know that I admire him a lot. He's got a special place on my Mount Rushmore of investment OGs. Anyway, let's dive into the story. So in the 90s, Buffett had this streak of buying shoe companies, and his shoe investments were crushing it. He had some amazing executives working for him in these shoe ventures. These guys were top-notch shoe people. They were like the Steve Jobs or the Elon Musk of shoes. He wasn't dealing with a bunch of Al Bundys. When you have top-notch management and a good business, it's a recipe for amazing results. Buffett liked this shoe business for a few reasons. Shoes are essentially a recurring purchase that everybody has to have. It's a necessity, so people are going to buy shoes even if their income decreases. Buffett likes these predictable types of investments where it's easier to make forecasts into the future. Even if there's some sort of crazy digital revolution, people are still going to wear shoes. So it's one of those boring but predictable businesses that's going to be around for a long, long time. Fast forward to 93, and he has this opportunity to buy Dexter Shoes. Like with most Buffett deals, this deal was structured so that the owner of Dexter Shoes would keep working at the company. The owner essentially wanted to cash out some of his personal net worth that he had built up in the business. But get this, like most companies that Buffett buys, the people running the companies actually want to stay and work in the business instead of retiring on a nice beach somewhere with a piña colada in their hand. It's amazing that these people love the business so much that they don't do it for the money. Warren agreed to buy Dexter Shoes for over $400 million. But he didn't use cash for this transaction. Instead of paying with cash, he essentially exchanged shares of his own company, which is Berkshire Hathaway, for shares of the shoe company. This probably seems like a small technical detail, but it's going to be important at the end of the story. That little detail is actually what made this investment one of the most painful mistakes of Warren Buffett's investment career. But before I get into that, let's go over what actually happened with this purchase. Dexter Shoes made most of their shoes in the US and Puerto Rico. Buffett admitted in his 1993 shareholder letter that he knew the conventional wisdom at the time was that the domestic shoe industry was not going to be able to compete with imports from low-wage countries. That was the conventional wisdom, and there were tons of articles about this all over the place. As a quick aside, in China today, an average factory worker makes around $3.50 an hour in wages. The average U.S. factory wage is around $16 an hour. I'm sure it was a similar situation back in the 90s. That type of math makes it super hard to compete if you're manufacturing in the U.S. And what made matters worse is that Dexter focused on shoes that were in the lower price range. And that made it that much harder for them to compete. It's not like they had an amazing brand that people loved. Buffett thought that the demand for the cheaper imported shoes would go away, or that the margins in his business would stay high because people would keep buying his shoes because of their brand name or because they were made in the US. Now, Buffett is known to avoid looking at macroeconomic trends. Instead, he likes to focus on businesses with good margins and great management. And Dexter had both of those things. As you're going to see soon, that was a big mistake. Essentially, Warren looked at the past performance and he thought that Dexter Shoes would keep trucking along making amazing cash flows without any disruptions from cheap shoes coming from overseas. The first couple of years after Warren Buffett bought the shoe company, they actually did really well and their results were pretty good. They were still able to compete with the cheap imports for those first few years. Then the tide turned, and by the end of the 90s, something like 90% of shoes bought in the US were imported. At that time, Berkshire Hathaway, which is Warren Buffett's company, they were the biggest US shoemaker. Warren Buffett dabbled with some international production of shoes, but he only did it a little bit because he was trying to keep all of the Dexter employees on the payroll. I think that Buffett had a soft spot for these American workers, and he didn't want them to be out of a job. A lot of the people working at the factories were older people, so it would be hard for them to get training to be able to do something in a totally different industry, and I think Warren Buffett really felt bad for them. Buffett tried to keep the majority of the shoe production in US factories, and eventually he admitted that mistake cost him. It was just too expensive to make shoes in the US, and the brands that Dexter Shoe had, they just weren't enough of a brand that people really wanted to buy. These shoes were in the lower price range, which meant that most people would just buy a different shoe if the Dexter Shoe was a little bit more expensive. The consumers didn't really care about supporting a US-made product. By 2001, Dexter lost so much money that the total Berkshire shoe operations ended up losing over $40 million that year. Buffett tried everything. He even changed up management at Dexter, but it was too little too late, and the company ended up getting combined with the other shoe operations at Berkshire Hathaway. Today, Dexter is a really small part of their overall shoe business, and they pretty much only sell Dexter bowling shoes. Going from a $400 million company to a niche bowling shoe is like going from being an Olympic swimmer to wearing floaties in the shallow end. A very humbling experience. The interesting thing is that Dexter did really well for the first few years after Warren Buffett bought it, and that made Warren get into a false sense of security. He thought that Dexter could compete well against these low-cost imports, but that was a mistake. Diving a little deeper, the issue with the purchase wasn't just that Dexter Shoes went to zero. That would be really painful, but what made it 20 times worse is that Berkshire issued stock to pay for the purchase. Okay, so this might sound a little technical, but just bear with me here because it's important to the story, and it's a good concept to understand if you're interested in investing. When Warren bought Dexter Shoes, he gave up around 2% of Berkshire stock and received 100% of the stock of Dexter Shoes. I think the main reason he did this was so that the Dexter owners wouldn't have to pay taxes when the company changed ownership. If Buffett gave the shoe people cash for their company, they'd have to pay tax on the sale of the shoe company, but doing this sort of exchange of shares meant that the Dexter owners didn't pay tax on the transaction. And when you're dealing with over $400 million for this transaction, I can see why they chose to do the stock exchange approach. They're probably sitting around thinking, so let me get this straight. If I sell the company to you, I have to pay how much in tax? Oh, okay. Well, I think we're going to go ahead with the stock exchange approach instead. Thank you very much. So as we've seen, Dexter Shoes pretty much went to zero. So the stock that Warren Buffett got went to zero as well. But the Berkshire Hathaway stock went up by a lot. The 2% or so of Berkshire that the shoe people got, today that would be worth around $10 billion. If Warren Buffett had paid for the shoe company using debt, Berkshire would be worth billions of dollars more today. So that's the risky part of giving up equity in transactions. If you give up equity, you're making a bet that whatever you get in return is going to be worth more in the future than the equity that you've given up. One little tiny aside that I want to mention is that the Dexter Shoe people were actually really, really good people. Harold Alfond, who's one of the main shareholders at Dexter, he donated tons and tons of money to charity, and he started this grant that gives a $500 college scholarship to every single baby born in the state of Maine. So yeah, it's sad that Buffett lost a ton of money on this deal, but at least the money went to a good guy that did lots for charity. I want to get into some of the key takeaways from this story, but before I do that, I'll quickly mention that if you're enjoying the podcast, please give us a rating and hit the subscribe button, and if you know someone who would find this content valuable, please share this episode with them. My goal for this podcast is to help people learn the lessons from the best investors and to help people understand the stock market better. I think that's really important today because there's a lot of information out there telling people to make risky YOLO trades, and I would love for people to be better informed about investing. Alright, so let's go over some key takeaways from this story. I'll start with saying that one of the great virtues that Warren Buffett has is that he's okay with admitting mistakes. After that whole Dexter ordeal, he admitted that it was a mistake, and he acknowledged that using shares of Berkshire as payment made it way, way worse. In 2014, Buffett even said that, and I quote, "As a financial disaster, this one deserves a spot in the Guinness Book of World Records." By the way, Warren Buffett doesn't sound anything like that, but good luck with imitating his accent. He has talked about how if you made a mistake, it's better to admit it, because that's going to help you remember the mistake so that you don't do it again. Many investors have trouble doing this because their ego gets in the way, but I think ego can cloud people's judgments like crazy. I think a valuable takeaway from this story is that it's good to admit your mistakes, and it's mission critical to learn from them. Sure, it's easier for Buffett to be open about his mistakes because he's had an amazing investment return over the years, even when you count this mistake. But I think that a reason that he has this sort of amazing long-term performance is because he admits to mistakes and learns from them. The other takeaway is that you often hear Buffett and Charlie Munger talk about if you've got a mediocre business and great management, the reputation of the business usually tends to win. Which means that the best management won't be able to get amazing results if the overall business or industry that they're in is a crappy one. Warren Buffett had the Steve Jobs of shoes working for him, and he still couldn't make Dexter Shoe work. And that's why Charlie likes investing in businesses that earn a high return on equity. Those types of capital-light businesses have great characteristics that will perform super well if you combine them with the right management. There's some businesses out there that might be selling for really cheap, but if you're in a crappy industry that has serious headwinds, it might be worth passing on those types of businesses. My other takeaway is that you've got to be careful when you're on a really good streak. Warren crushed it with some shoe company purchases, which led him to feel very confident about Dexter Shoes. Now you gotta remember, Warren reads the Wall Street Journal every single day, so he knew that cheap shoe imports were coming into the US. But his previous successes with the other shoe companies set him up for failure with Dexter. I think the lesson here is to treat each investment individually. If Warren didn't have the success of the previous shoe investments, maybe he would have been more cautious with Dexter. The data about the cheap shoe imports was pretty clear. They were increasing every year and people were buying lots of them. Now, don't get me wrong, Buffett is not a big macro type of guy. He doesn't like to forecast interest rates or currencies. But the pattern of cheap imports into the US is not really a typical macro issue. So that's another thing to keep in mind. I don't think in investing you can predict big macroeconomic events. At least I can't. But what you can do is look at some of these shifts happening in different industries. And some of these shifts are fundamental shifts that are going to change how people do things for a long time. I would have not liked to be in the horse buggy making business when cheap Ford Model Ts started to appear on the market in the early 1900s. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, leave a review, and if you know someone who's interested in investing, please share this episode with them. Thanks so much for listening, and I hope you have a great day. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast.